Money feels solid only because we are trained to treat it as solid. A banknote is paper. A digital balance is a number in a database. Neither feeds you, shelters you, or powers a factory on its own. Yet entire societies organize their labor, time, and obedience around these abstractions. This works for one reason only: collective belief. Modern finance is not built on gold, productivity, or even law. It is built on trust, quiet, invisible, and usually unquestioned. For most of human history, money had a physical anchor. Coins were precious metals. Their value was intrinsic, or at least constrained by scarcity and effort. When trusts and rulers failed, people could still melt the coin. Fiat money broke that link. Once currency stopped being redeemable for gold, value became purely relational. A dollar is worth a dollar because everyone agrees it is. The agreement is not written anywhere enforceable in nature. It exists only in the shared psychology of society. This is not a flaw in the system. It is the system. Every major financial institution today is a promise-making machine. Banks do not hold your money in a vault. They lend most of it out. What you own is a claim, not the cash itself. Your balance is an IOU backed by confidence that the bank will honor withdrawals when asked. Insurance companies do not have enough capital to cover every claim simultaneously. Pension systems assume future workers will exist, pay taxes, and fund retirees. Sovereign bonds are promises that future governments will choose to repay debts issued by past governments. None of these structures could survive universal doubt. They survive because doubt is rare, localized, and socially discouraged. Trust is what turns fragility into stability. As long as most people believe the system works, it does work. A bank that is fundamentally solvent can still fail if enough depositors panic. A government with taxing power can still lose access to markets if investors lose faith in its willingness to act responsibly. These are not theoretical claims. History shows repeatedly that financial systems fail not when resources disappear, but when belief evaporates. In 1930, during the early stages of the Great Depression, thousands of U.S. banks collapsed. Many were not insolvent in a balance sheet sense. They were illiquid. Depositors, frightened by headlines and rumors, rushed to withdraw cash. Banks were forced to sell assets at fire sale prices, turning temporary liquidity problems into real insolvency. The physical economy had not suddenly vanished. Farms still produced food. Factories still existed. What collapsed was confidence in the intermediaries connecting savings to production. The same dynamic reappeared in 2007 with Northern Rock in the United Kingdom. The bank relied heavily on wholesale funding rather than retail deposits. When credit markets froze, rumors spread that it could not refinance its obligations. Customers lined up in the streets to withdraw their money, the first bank run in the UK in over a century. The British government eventually guaranteed deposits, restoring trust. The bank did not fail because houses disappeared or workers forgot how to build. It failed because belief cracked. What makes trust so powerful is that it is self-reinforcing. When people believe a system is stable, their actions make it stable. When they believe it is fragile, their actions make it fragile. This reflexivity, described by economists like George Soros, is central to modern finance. Prices, credit availability, and even political legitimacy respond not just to fundamentals, but to expectations about expectations. Consider sovereign debt. A government that issues debt in its own currency, with a central bank behind it, technically cannot run out of money. Yet bond markets still discipline states. Why? Because investors are not pricing physical capacity. They are pricing trust. Trust that inflation will be controlled, that contracts will be honored, that policy will remain predictable. When that trust weakens, yields rise. Higher yields worsen fiscal stress, further eroding trust. The spiral is psychological before it is mathematical. This is why credit ratings matter far more than their crude models would suggest. A downgrade is not just an assessment of numbers. It is a public signal that trust has diminished. Markets react not because a letter change, but because other investors might react. Again, belief about belief moves capital. Even cash itself is a trust instrument. A banknote says nothing about what you can buy tomorrow. It contains no guarantee of purchasing power. During hyperinflations, people still accept money until they do not. In Weimar Germany in the early 1920s, prices did not rise smoothly. They jumped as confidence snapped. Once workers rushed to spend wages immediately, velocity exploded. The same quantity of money became worthless not because paper increased overnight, but because nobody wanted to hold it. Trust in future value died, and with it the currency. The modern financial system is often described as complex, technical, and mathematically sophisticated. In reality, it rests on something primitive: social cohesion. People accept money because they believe others will accept it. They deposit savings because they believe others will not withdraw all at once. They buy long-term bonds because they believe society will still function decades later. None of this is enforceable at the individual level. It is a shared narrative reinforced by habit, law, and authority. Central banks understand this deeply. Their most powerful tool is not interest rates or balance sheets, but credibility. When a central banker speaks, markets listen not to the words themselves, but to whether the speaker is believed. This is why consistency matters, why surprises are feared, and why policy reversals are dangerous. Once credibility is lost, regaining it is painfully slow. The uncomfortable truth is that there is no solid floor beneath modern finance. There is no final anchor. Gold is marginal. Law is reactive. Force is too blunt. What holds the system together is a collective decision to keep playing the game. Most of the time, this decision is unconscious. People go to work, swipe cards, check balances, and plan futures without questioning the foundation. Trust is invisible precisely because it is everywhere. But invisibility is not invincibility. When belief weakens, it does not announce itself with explosions or sirens. It starts as hesitation, a delayed investment, a preference for liquidity, a joke about money that no longer sounds like a joke. The system can look perfectly intact while its core is hollowing out. No buildings fall, no servers shut down. Yet something essential is gone. Understanding finance, then, is not about understanding money flows alone. It is about understanding human psychology at scale. The real infrastructure of the system is not banks or exchanges, but confidence itself. And like all psychological constructs, it exists only as long as people continue to believe. A financial system does not need to break in order to collapse. It only needs to be doubted. This is a paradox at the heart of modern crises. The visible structures can remain standing while the system ceases to function. Banks can open their doors. Markets can keep trading. Governments can still issue statements. Yet underneath, the mechanism that makes all of it work, confidence, can already be gone. Traditional images of collapse are physical: empty ATMs, closed banks, bread lines. These are late-stage symptoms. By the time they appear, the real collapse has already happened. The decisive moment occurs earlier in the collective mind, when people stop assuming tomorrow will resemble today. Finance, more than any other system, is forward-looking. Prices, credit, and investment are based on expectations of future behavior. Once those expectations fracture, the present reorganizes instantly. Bank runs are the clearest example of collapse without physical failure. A bank does not need to be insolvent for a run to destroy it. It only needs depositors to believe that other depositors might withdraw first. This logic is brutally simple. If you trust a bank and everyone else does too, leaving your money deposited is rational. If you trust a bank but think others might panic, withdrawing immediately becomes rational. Individual rationality produces collective disaster. This dynamic has repeated across centuries with remarkable consistency. In the United States between 1930 and 1933, waves of bank runs swept through the country. Most depositors were not reacting to detailed balance sheet analysis. They were reacting to headlines, rumors, and visible cues. Seeing others withdraw was enough. The physical assets backing the banks did not vanish overnight. What vanished was a belief that deposits would remain accessible if one waited. The same logic operated during the 2008 global financial crisis. Money market funds in the United States were perceived as safe, near cash instruments. When the reserve primary fund broke the buck after Lehman Brothers collapsed, confidence evaporated. Investors rushed to pull hundreds of billions of dollars within days. The funds held assets that would have matured over time, but immediate redemption demands forced fire sales. The system froze not because the underlying economy had stopped producing, but because trust in short-term promises disintegrated. Collapse without collapse is not limited to banks. Sovereign debt markets operate on the same psychological foundation. Government bonds are often described as risk-free assets. This description is misleading. They are risk-free only as long as markets believe the issuing government is both willing and able to honor its commitments without debasing the currency. Once that belief weakens, bond markets can turn violently. In the Eurozone crisis after 2010, countries like Greece, Italy, and Spain did not suddenly lose their physical capacity to produce goods or collect taxes. What changed was investor confidence in the political and institutional framework supporting the euro. Yields spiked not because the mathematics of debt changed overnight, but because markets began to doubt whether repayment would occur under existing rules. The fear was not insolvency in a narrow sense. It was a breakdown of trust in governance. This is why language from policymakers matters so intensely during crises. Markets listen for reassurance not because words have magical power, but because they shape expectations about expectations. When European Central Bank President Mario Draghi said in 2012 that the ECB would do whatever it takes to preserve the euro, bond yields fell sharply across the periphery. No immediate cash transfers occurred. No debts were forgiven. The system stabilized because belief was restored. A psychological intervention produced material effects. Modern technology accelerates these dynamics. In earlier eras, panic traveled at the speed of rumor and print. Today it travels at the speed of notifications. Depositors no longer need to line up outside banks. They can withdraw funds instantly with a tap. Social media amplifies fear by making private doubt visible. A single viral post can trigger a cascade of withdrawals. The collapse begins not when money runs out, but when people realize others are losing confidence. This creates a fragile equilibrium. The system functions beautifully as long as trust is assumed. But once doubt becomes common knowledge, behavior shifts abruptly. Investors hoard liquidity. Banks tighten lending. Companies delay hiring and capital expenditure. These actions are defensive and individually rational. Collectively, they slow the economy and validate the original fears. What began as a psychological shift becomes an economic reality. Importantly, none of this requires fraud, mismanagement, or external shocks at the moment of collapse. Those factors may exist in the background, but the trigger is belief. A solvent institution can fail. A functioning market can freeze. A stable currency can lose acceptance. The common thread is not material depletion, but expectation failure. This is why financial crises often appear sudden. In reality, they are slow accumulations of doubt followed by rapid behavioral change. For years, vulnerabilities can build quietly. Leverage increases. Risk concentrates. But nothing breaks as long as confidence holds. When it does not, the transition from stability to dysfunction can occur in days or even hours. The unsettling implication is that no amount of technical robustness can fully protect a financial system from psychological collapse. Capital buffers, regulations, and stress tests all matter, but they are secondary to belief. They work because people believe they work. Once that belief is questioned, the protections themselves come under suspicion. A system can therefore look intact at the exact moment it stops functioning. Screens still show prices. Banks still report capital ratios. Governments still announce policies. Yet participation changes. Trust quietly withdraws. And when trust leaves, finance does not fail loudly. It simply stops being believed. Once trust is recognized as a core operating system of finance, it becomes clear that modern policy is less about managing economies than managing belief. Central banks, treasuries, and regulators are not just economic actors. They are narrative authorities. Their primary task is to shape expectations, anchor confidence, and prevent doubt from becoming contagious. Interest rates and liquidity facilities are often presented as technical tools, but their true function is psychological. A rate cut signals concern. A rate hike signals control. Emergency lending programs signal that someone powerful stands behind the system. The actual flow of money matters, but not nearly as much as what that flow implies about future stability. Markets react first to meaning, then to mechanics. This is why central bank communication has evolved into a discipline of its own. Forward guidance did not emerge because markets demanded more words. It emerged because policymakers realized that expectations themselves were a policy lever. By telling markets what they intend to do in the future, central banks attempt to reduce uncertainty in the present. The goal is not precision. The goal is reassurance. The European Central Bank's response to the Eurozone crisis illustrates this clearly. In July 2012, Mario Draghi stated that the ECB was ready to do whatever it takes to preserve the euro, adding, "And believe me, it will be enough." At that moment, the ECB had not launched a massive bond buying program. It had not mutualized debt. It had not changed fiscal rules. Yet yields on Spanish and Italian bonds fell sharply. The crisis eased not because resources were deployed, but because belief shifted. Markets concluded that the ECB would not allow catastrophic outcomes, and that conclusion changed behavior immediately. The U.S. Federal Reserve's response to the COVID-19 shock in 2020 followed the same pattern at a larger scale. Financial markets froze in March as uncertainty exploded. In response, the Fed announced unlimited quantitative easing, emergency lending facilities, and support for corporate bond markets. Many of these programs were barely used. Their power lay in their existence, not their utilization. By signaling that there was no effective limit to its willingness to intervene, the Fed restored confidence. Credit markets reopened. Equity markets rebounded. The real economy was still shutting down, but the financial system stabilized because belief had been re-anchored. This reveals a crucial paradox. The more the system relies on confidence management, the more fragile it becomes. If stability depends on reassurance, then reassurance must be continuously supplied. Each intervention sets a precedent. Markets learn that extreme outcomes will be prevented. Over time, this encourages risk-taking and leverage, which increases the system's sensitivity to shocks. Eventually, words alone are no longer sufficient. Credibility must be backed by ever larger actions. Narrative control also has limits. Trust cannot be commanded indefinitely if lived experience contradicts the message. When inflation remains high despite assurances of transience, credibility erodes. When asset prices soar while wages stagnate, confidence and fairness declines. When bailouts protect institutions but not households, belief in the system's legitimacy weakens. These fractures do not cause immediate collapse, but they accumulate quietly. Governments participate in belief management as well. Fiscal announcements, debt ceilings, and budget negotiations are as much about signaling reliability as they are about funding programs. A government that appears politically paralyzed can lose market confidence, even if its economic fundamentals are strong. Conversely, a government that projects decisiveness can borrow cheaply despite high debt levels. Again, perception leads reality. The role of media and financial commentary amplifies this process. Markets do not simply react to events. They react to interpretations of events. Analysts, rating agencies, and news outlets act as belief intermediaries. Their narratives shape what investors consider plausible. A downgrade, a headline, or a widely shared chart can shift sentiment far beyond what underlying data would justify. In this environment, confidence becomes reflexive and unstable. Crucially, belief management works best when it is invisible. As long as people assume stability is natural, interventions feel reassuring. When people begin to notice that stability requires constant support, anxiety grows. Repeated emergency measures signal not strength, but dependence. Each promise to do whatever it takes raises a question of what happens when that promise is tested. At the extreme, belief management turns into denial. Authorities may suppress bad news, delay recognition of losses, or rely on optimistic projections to avoid panic. These tactics can buy time, but they also deepen mistrust when reality eventually asserts itself. Once credibility is lost, it cannot be restored with announcements alone. Markets become hypersensitive, interpreting every statement as a potential deception. This is a fundamental constraint facing modern finance. Trust can be guided, influenced, and temporarily repaired, but it cannot be manufactured from nothing. It must be grounded in consistent behavior and outcomes. When actions diverge too far from promises, belief weakens. When belief weakens, the entire structure becomes unstable. Managing belief, then, is not optional. It is unavoidable, but it is also dangerous. The system increasingly depends on confidence maintenance to function at all. And the more that confidence must be actively managed, the more precarious it becomes. When belief finally breaks, it does not do so evenly or politely. It fractures. Some people stop trusting institutions long before others do. Some exit quietly, shifting behavior while the system still appears functional. By the time distrust becomes visible at scale, the point of reversal has often already passed. The first sign is not chaos, but substitution. People do not wake up and reject money outright. They begin to prefer alternatives. Cash over deposits. Hard assets over financial claims. Short-term over long-term promises. These are not ideological decisions. They are defensive adaptations to uncertainty. Trust does not disappear. It relocates. History provides repeated examples. In Weimar Germany, as confidence in the mark collapsed, workers demanded to be paid daily. Merchants adjusted prices multiple times per day. Barter reemerged. Foreign currencies circulated informally. The state still existed. Laws still applied. But the monetary system no longer organized economic life. It had lost its coordinating function because belief in its future value had vanished. In Argentina, episodes of currency crisis followed a similar pattern. Long before official devaluations, citizens learned to think in dollars. Prices, savings, and contracts were mentally denominated in a foreign unit of account. The peso continued to circulate, but it was no longer trusted as a store of value. The financial system did not collapse physically. It hollowed out psychologically. A parallel system replaced the official one. Lebanon's recent crisis shows the modern version of this breakdown. Banks did not close immediately. ATMs did not empty overnight. Instead, informal capital controls emerged. Depositors discovered that their balances were trapped, payable only at unfavorable rates. Trust evaporated. People stopped viewing bank deposits as money. They became claims of uncertain worth. The banking system survived in name, but it ceased to perform its basic function. When belief breaks, social behavior changes in ways that are difficult to reverse. Long-term planning disappears. Investment horizons shrink. People prioritize immediacy and resilience over efficiency. This shift is rational at the individual level, but devastating collectively. Economies depend on trust in the future to justify specialization, credit, and deferred gratification. Without it, productivity suffers. At the political level, legitimacy erodes alongside monetary trust. Governments rely on financial systems to collect taxes, fund services, and enforce contracts. When money loses credibility, compliance weakens. Informal economies expand. Rule following becomes conditional. The state may still have authority, but it loses psychological consent. This is why monetary crises often precede or accompany political instability. Importantly, belief does not break because people suddenly understand economics better. It breaks because lived experience contradicts official narratives too consistently. When wages lose purchasing power year after year, assurances ring hollow. When savings are frozen or diluted, promises feel fraudulent. Trust is experiential. Once violated, it is remembered. At this stage, restoring confidence becomes extraordinarily difficult. Policy tools lose effectiveness. Interest rates no longer anchor expectations. Guarantees are questioned. Even aggressive interventions can fail if they are perceived as desperate or unfair. People do not ask whether authorities can act. They ask whether authorities should be believed. The final outcome of belief collapse is not necessarily a dramatic end. Systems can persist in degraded form for years. Money circulates, but it is not trusted. Banks operate, but they are avoided. Official markets exist, but real activity shifts elsewhere. Society adapts around the failure rather than through it. This is a quiet end of financial systems, not with explosions, but with indifference. When people no longer believe, they stop participating. And without participation, finance loses its purpose. Money is not destroyed by printing too much of it. It is destroyed when no one wants to hold it. Banks do not fail because assets vanish. They fail because trust withdraws. Governments do not lose power because they lack force. They lose it because belief dissolves. Trust is the real currency. And when it is gone, everything built on it follows.